Welcome to the lecture on valuing financing effects. So what do I mean by that, financing effects? Well, recall Modigliani and Miller. Remember, everything in corporate finance in one way or another goes back to M&M. So they made certain assumptions that made finance irrelevant. In particular, they said that there's no taxes, there's no information problems. The investors know as much as the managers know about the firm's prospects. Likewise, there's no conflicts of interest with management. You can keep going on. The prices should be kind of correct. Prices should reflect all of the information that's out there. So if you look in the stock market, the price for a given stock should reflect all of the information pertaining to that stock. We made some other assumptions as well, such as investors can trade on the same terms as the rest of as the company can. Okay, so these are 5 big assumptions that they made. They made one more that's a little bit harder to talk about, but the point is, finance becomes irrelevant under these assumptions. So when does finance become relevant? When does finance have an effect? In other words, it's when we violate one of these assumptions. Okay. If you violate the no taxes assumption, now maybe finance matters. If you violate the no conflicts of interest assumption, now maybe finance matters. We need to have a way to measure these things. In our class, we're going to focus on taxes. Okay. Taxes are a relatively simple effect to value to put a number on. We're not going to talk about these other assumptions very much. We're going to try to pin down the effect taxes have on a project's value. Okay, so why do taxes matter? Well, we know from M&M that debt is preferred. Debt gives you this tax shield. So in this class, we mean those tax shields. We need to value those interest tax shields. That's what we talk about when we say, when we're talking about valuing financing effects. Okay, so that's big picture. In this slide deck, we're going to talk about a few different methods for doing that. One we've already seen, the weighted average cost of capital. We'll see how the weighted average cost of capital accounts for those tax shields. But we know that the weighted average cost of capital has some restrictions. And so we need to have other tools to get around these restrictions. One that we'll see is the adjusted present value method, APV. Another is the flow to equity method, FTE. So what we'll do is we'll define each of these methods. We'll talk about the steps. Each of these 3 methods have distinct steps that you follow to value the projects. So every WACC problem is going to have the same couple steps. Every APV problem is going to have the same couple steps. The steps for a WACC problem are going to be different than the steps for APV, but there's patterns for kind of each method. So once we talk about those patterns, then we're going to do some examples and try to drive it home and make sure that we understand those steps. First, we'll do a very simple example, but we'll do it 9 different ways. Okay, so it's kind of a trivial firm, but we want to make sure that we know the steps for each of these methods, and so we want to do it a bunch of different ways just to kind of drill it into our heads. Then we'll do a couple more complicated examples. For number 5, we're doing more of like a mini case study, you can think of it. We'll value this project using all 3 methods again, and then we'll start to think about when each method becomes preferable. For number 5 here, we'll see that if you have a stable capital structure, then you're going to want to use WACC. WACC is built and designed for projects where you have a stable capital structure. And so if that's the world that you're working in, WACC is perfect. These other methods are going to be harder to use. But then in point 6, we're going to do another example where your capital structure is changing over time. You have a more flexible capital structure. And if that's happening, then the WACC is not going to work very well. We know that when your capital structure changes, you have to do all of this delevering and relevering business. So the WACC is going to be very hard to implement, Conversely, APV is going to be like trivially easy for number 6. Okay, so it's useful to do a few examples to see when one method works well versus another method. So this is the world we're talking in. This is my introduction here. Capital structure matters now, right? We've moved away from these M&M assumptions. In particular, we've moved away from this no taxes assumption. And if we move away from that, then finance is no longer 0 NPV. Some things are worth doing because of those tax shields. Right? There's some projects that we're going to take if we get the tax shields, and we wouldn't take them if we don't get the tax shields, right? That kind of pushes us on the margin to take certain projects. There's a couple, like we discussed, there's various reasons why finance can matter. We're going to talk about the tax shields, but you could think about, cost of bankruptcy. So I forgot about that other assumption. When we talk about M&M, we said that there was no problems with bankruptcy. If you go into bankruptcy, no big deal. You just transfer the firm from the management to the bank, and the bank can run it without losing any value. Okay, that's an assumption with M&M, but you can think about that not being true. That would be another place where finance can affect firm value. Okay, so there's all these different places where finance can affect firm value, but we're gonna focus on these tax shields. We're going to talk about 3 different methods. I want to outline the main ideas for each of them here. First one we've already seen a little bit, the WACC. What are we doing big picture with the WACC is we're pushing the discount rate down to account for the tax shields. Where do we see this? Well, if you just write out the WACC formula, we've got debts over value times RD times 1 minus T plus E over V times RE. Okay. Where's the tax shield showing up here? Well, we said that the tax shield is showing up in this 1 minus T term. We recognize that when we pay the bank a return, RD, it doesn't really cost us RD. It only costs us RD times 1 minus T, because every dollar you give the bank, you get a tax deduction of T cents. Okay, so that's a big idea here. If we can push the discount rate down, then all of those future cash flows that we discount are going to be worth more. Right? If you have a lower discount rate, those future cash flows are now worth more to us. How much more are they worth? Well, they're worth the amount of the tax shields. Right? How much does the value of the project go up? It goes up by exactly the value of all of those interest tax shields from the project. That's the big idea here. Everything shows up in the discount rate, so it's a little bit stringent, right? It's not very flexible. So we want to have another method that's more flexible, and that's APV. The key idea with APV is that we can break the financing into a separate part. Remember, with capital structure, we said that the value of the levered project can now be thought of as the value of the project without leverage, VU, that's unlevered, plus the value of those tax shields. Okay. So the value of the levered firm, the value of the levered project, VL, that's the value of the project without leverage. It's unlevered VU, plus all of the financing value, VITS. So with APV, we're going to separately value each of those things and then add them up. That's where we're going to get flexibility, because we're breaking the project into small pieces. We're going to separately get the value of the project without debt and the value of the tax shields, and then add them up. And by breaking it down into smaller pieces, that gives us more room to change our assumptions and tweak things. And so it's more flexible. third method we're going to talk about is called flow to equity, FTE. The key idea here is that equity holders care about financing effects. When you get tax shields, we know that equity holders like that, right? They benefit from those tax shields. And so if we just focus on the equity, we can still value the project. How are we going to focus on equity? Well, we're going to get the cash flows that can go to the equity holders, and then we're going to have the discount rate for the equity. And you just discount the cash flows to the equity holders by the discount rate for the equity, and that gives you the value of the project. So these are the three methods. We're going to talk about the steps that we're going to use for each of them, but they're all trying to account for these tax shields. They all do account for the tax shields in different ways. One's through the discount rates, the other is by explicitly modeling the tax shields by themselves, and the third is to focus on equity, because the equity holders, the cash flows that are going to the equity holders, account for those financing effects. So the cash flows going to equity holders include ITS. So we have those, we discount them by the appropriate discount rate, and we get the value of the project. Now I want to talk kind of in detail about the steps for each of these three methods. The steps to use the weighted average cost of capital are relatively straightforward. So just to remind you, we forecast the free cash flows, and then we discount them by the WACC, and that's it. Remember that the free cash flows are generated by the operations of the company. They have nothing to do with financing. They're just from the operations. The financing effect shows up through the discount rate. And we said this 1 minus t term, that's picking up those tax shields. So when we discount the free cash flows, which are just from the operations, by the WACC, which is lower because of the tax shields, the combined effect includes both the operations as well as the tax shields. This is important to remember. We don't discount any of those financing cash flows. We don't include those tax shields at all when we do the WACC. We explicitly leave that out. And the cash flows that we use are only from the operations. They're just the free cash flows. If we wanted to, theoretically, we could modify the WACC to incorporate other financing effects. So here's the interest tax shield. If we wanted to, we could try to move the discount rate to incorporate some of these other frictions. If some of these other M&M assumptions are violated, we could try to incorporate those into the discount rate too. It's not very standard to do that, so we won't, but it's something that you could do. So here's the steps for the WACC again. It's the simplest method. You just forecast the free cash flows. Those are ignoring financing, they ignore interest. You find the WACC, and then you discount the free cash flows by the WACC to give you everything together in one step. You get the total value of the project as well as all the tax shields. The main advantage is that the WACC is very easy and it's very standard. Everyone knows it, everyone uses it. The disadvantage is we know that we're tying our hands a bit. The WACC only works very well if you have a stable capital structure. Again, if these ratios change, then the entire formula is going to change and you got to do all this delevering and relevering business. We also know that the project has to look like the firm. remember that you only get one WACC for the entire company. Right? You only see what's going on with the entire company's equity. You only see what's going on with the entire company's debt. You can't separate a project's equity from the company's equity. So when you do this, you just get one number for the entire firm. If you want to use this for an individual project, it better be the case that your project looks like the firm. So that's intuitive. The main method we have to relax some of WACC's assumptions is called APV. We talked about the big idea here. Let's talk about the steps now, kind of the particular steps for going through a APV problem. It's going to be two steps. We've got two streams of cash flows now. We've got VU we want to find, and we have VITS. So we have to do twice as much discounting as with the WACC. The first step is to find the value of the operations. Forget any financing, strip away any financing effects, just get at the assets, just get at the operations. Right? That's VU, that's the value of the project without any debt, without any financing effects. Right? Unlevered, U for unlevered, no financing. How do we get that? Well, we discount the free cash flows, which as we recalled above, the free cash flows are from the operations, right? Not from the financing. We discount those free cash flows by RU. RU is the return on the assets, right? The return on the operations. Again, it ignores all financing. It's just how risky are the operations. That's the required return on the operations, kind of given their risk. So we have the cash flows from the operations. We have the discount rate for the operations. We put those things together to get the value of the operations themselves. The second step then is to find the value of the tax shields. That's VITS, the value of all those interest tax shields. We need to have a separate stream of cash flows for the ITS. Now we have to separately forecast what's going on with the tax shields period by period. And we're going to discount those by the appropriate risk of the tax shields. What is this thing, the risk of the tax shields? It depends on the capital structure, right? We talked about this quite a bit with the delevering and relevering lecture, if you recall. We need to know what drives our tax shields. One possibility is that your tax shields grow and shrink with the assets of the company. We discussed this scenario if you have a stable capital structure. So if debt to equity is stable, then we said that the assets grow, that makes the debt grow, which makes the tax shields grow, and vice versa. And so we had this relationship. We had the assets lead to the debt level, which leads to the interest tax shields. So therefore, the risk of the tax shields is tied to the risk of the operations. Now that's not the only possibility. It's also possible that the tax shields are not tied to the assets. So this could happen if you just hold a constant level of debt, for example. If debt is just not tied to the operations of the company, so for example, you just have a constant level of debt, at, say X dollars. I'm just going to have X dollars in debt today. I'm going to keep X dollars in debt tomorrow for as far as I can see. In that case, that level of debt is not tied to the assets in any way. So the tax shields are not tied to the assets. If that's how the capital structure is going to evolve, then we'll have that the risk of the tax shields is only equal to the risk of the debt. It's not tied to the assets anymore. Now you get the tax shields as long as you pay the debt. The tax shields are then less risky. This is what gives APV so much flexibility. It's these extra steps that we got to think about, which is a little bit painful. But those extra steps mean we can break things into finer pieces. We can get more granular in our valuation. And that's going to allow us more flexibility in how we value the firm or the project. Right now, the project doesn't have to look like the firm. The project can look very different from the firm, but we can have enough levers here. We have enough places where we can fiddle with the parameters so that we can account for that stuff. We can account for any difference between the project and the firm, or we can account for changes in the capital structure of the firm if we wanted to do that as well. So this is all summarized in the slide. The first step is to calculate the value of the project without any debts. Listed that there. Find VU by discounting the free cash flows by RU. How do we get RU? Well, we saw this a little bit with the delevering and relevering. If the capital structure is stable, then we can use the pre-tax WACC. So I think on some old exams, what I'll do is I'll have the company that you're interested in does not have a stable debt to equity ratio, but maybe there's a competitor company in the same industry with similar assets, and they do have a similar debt to equity. They have a stable debt to equity ratio. So what you can do is you can delever this competitor company to get the return on the assets for the company that you care about. The key is you need to know this RU. How you get that RU, you can get it from a competitor company, or you can get it from the company that you're interested in primarily. It doesn't matter how you get that, but the point is you need that RU in order to find the value of the company without any debt, the VU. Okay. And then we talked about the different possibilities for RITS. We said that if the tax shields are inherently tied to the assets, then the risk of the tax shields look like the risk of the assets. And then we should use this RU number to discount both the free cash flows as well as the tax shields. But it doesn't have to be that. It could be that the tax shields are only tied to the debt, and the debt is not tied to the assets in any way, in which case the risk of the tax shields would be the risk of the debt. And we could find the value of the tax shields that way. The main advantage is its flexibility. The disadvantage is it's a little bit more work. Right? With the WACC, we just had this one step. With APV, we got to figure out all of this stuff. Okay, doing that gives us the flexibility, gives us the granularity, but that's the cost benefit here with APV. It's also easier to think about other effects of financing. We're going to focus on the tax shields, but if you wanted to come up here and think about bankruptcy costs, for example, you could plausibly forecast how expensive bankruptcy would be for your company. And you can use that to value the capital structure effect, right? If I have a lot of debt, maybe I'm going to go bankrupt, and I want to know how much that costs the firm. I could forecast those costs of bankruptcy and then discount them by the appropriate rate and include that in my analysis. So it's much more flexible on a variety of dimensions. It's also nice that you can explicitly forecast all of these cash flows. You can keep track of where the value is coming from a bit easier. You have the cash flows from the operations, and then you have the cash flows from the tax shields, and you can break them up and view them each separately. With the WACC, we couldn't do that, right? Everything was just lumped together. You just have the free cash flows and the WACC, and then you kind of trust that it's picking up everything you want, but it's a little bit opaque. With APV, you're seeing everything right before your eyes when you're doing the valuation. Okay. The last method I want to talk about is flow to equity. So the big idea is we're just going to focus on what's going to the equity holders because the equity holders are benefiting from the tax shields. And so the financing effects are there, right? We know that they're in those cash flows to the equity holders. We just need to value them. Okay. The steps here are to calculate the cash flows that are available to the equity holders. We're going to give that a special name. That's going to be the free cash flows to equity. Or FCFE for short. We discount those by the required return on equity. Okay, so everything's equity focused. We have a return for equity, RE. We have the cash flow to equity, FCFE. Put those two things together to get the value of the project. The new variable we need to be comfortable with is this thing called FCFE. Okay. So in words, this is how much the company could pay to the equity holders at any given moment. How much cash is coming into the company that you could turn around and give to the equity holders. We start with the free cash flows. The free cash flows are generated by the operations, so you could take those and pay them to the equity holders. The equity holders can't touch, however, any interest payments. If you give $1 to the bank, the equity holders, you can't give that $1 to the equity holders, right? So it's foreclosed on them. They can't touch that. The interest payments, however, do have this tax effect, right? This is where the interest tax shields are showing up through this T term. If I give $1 to the bank, it doesn't cost the equity holders $1. It costs the equity holders 1 minus T dollars because the equity holders benefit from the tax break. They benefit from those tax shields. So that's showing up here. Okay. But generally, they can't get access to those interest payments. The last piece is any new debt. We can call this net borrowing. We can call it net debt issuance. Right? If you take out a big loan, you could take that money and give it to the equity holders. Conversely, if you pay off principal on an old loan, that's now money that you can't pay equity holders anymore. So I'll make a little note of that here. This net borrowing, this could be positive if the company takes on more debt. Or it could be negative if the company is paying off old debt. From the equities perspective, they can get their hands on the net, right? If I take out a big loan, that's more money you can give to equity. If I pay off the old loan, that's now less money for the equity holders. Okay. But those are the only two things you need. You need to know the discount rate on the equity and the cash flows to the equity holders. And then you discount those FCFE by the RE, and you're done. Okay. The main advantage is that you don't need to concern yourself too much with the free cash flows. You only need to know how much cash the equity holders can get. You don't need to worry about drawing this line between a cash flow from operations versus a cash flow from financing. Remember that the free cash flows are from the operations. And we need those for APV. So first step of APV is to discount the free cash flows. We also need the free cash flows for the WACC. How do we value the company with the WACC? We discount the free cash flows by the WACC. Okay, so in both the WACC method and the APV method, we need to know what the free cash flows are. What if you have something like a financial institution? You have a bank. With a bank, all of their operations are in financing. Their whole business is in interest revenues and interest expense, right? With free cash flows, we're excluding that stuff. We're saying all we care about is operations and not financing. But with a financial institution, you can't separate these two things. Their operations are in the financing. So I'm not going to be able to get the free cash flows for a bank very easily. We have a way around this with flow to equity. With flow to equity, it says, well, we don't really need to draw a line here. We don't need to say this is a free cash flow and this is from financing. We don't need to make that distinction because all we need is the cash flow that's available to the equity holders. Okay, and that includes all of the financing that the company is doing. Okay. So that's the main benefit with flow to equity is we don't need to draw a line between operating cash flows and financing cash flows. It's not going to be possible to do that with some companies. We can just look at what's going on with equity and that's enough. The disadvantages are similar to the WACC. Mainly, you need to know the discount rate on the equity. Right? You need to discount the free cash flow equity by the discount rate for equity. Well, if the capital structure of the company changes, we know that we need to relever and go through that whole dance. So if the capital structure changes, you need to calculate a new RE, and then the free cash flow to equity, or the flow to equity method becomes a bit more challenging. So the disadvantages look similar to WACC, but you do have the advantage of not needing to separate operations from financing. Next, I'm going to go through a very simple example, and I'm going to solve it 9 different ways. The point here is to make sure that we can go through the steps for each of these methods. I'm going to use the WACC method, the APV method, and the flow to equity method. So I'm going to use 3 different methods, and I'm going to apply them to the simple firm, and I'm going to apply them for 3 different capital structures for this firm. So you got 3 methods times 3 capital structures, so you get 9 valuations. We're going to value this company 9 different ways. The company is called Cougar Printing, and they're just a perpetuity. Their EBIT is going to be $10 per year forever, and we're given the discount rate on the assets. That's RU, right? The return on the unlevered company. That's 10%. We have no CapEx, no depreciation, and no changes in net working capital. So the only component of the free cash flow that we have is the EBIT. We know that their cost of debt would be 5% if they raise debt. So they start with 100% equity, and they're thinking about raising some debt. Okay. If they raise debt, then the cost will be 5%. So the expected return on the debt will be 5%. The only capital structure friction we have, the only financing friction, is the tax deductibility of interest payments. So everything else Modigliani and Miller assumed is true. We just have taxes now, and we know that interest payments are tax deductible. The rate is 30%. We're going to value this 9 different ways. 3 methods under 3 different capital structures. The first is going to be with 100% equity. Then we're going to value the company if it has 50% equity and 50% debt, where we're going to keep the debt to equity ratio stable going forward. Okay, so remember, when we value those tax shields, what's important is not necessarily the capital structure today, but also what's going to happen to the capital structure going forward. So in this case, the debt to equity ratio is going to stay constant. If the assets do well, you take on more debt. If the assets do poorly, you take on less debt, right? So it's tied to the assets here. The third capital structure we're going to consider is, again, 50% debt and 50% equity, but now the level of debt is going to stay constant. So you're just going to have some level of debt, and you're just going to keep it at that level no matter what happens to the assets. We're going to see how company value changes when we change that assumption. Okay, so let me pull up a second whiteboard. I'll just put all the information from the slide onto the whiteboard so that we can then refer to our 2 whiteboards. We have our 3 methods of valuing financing here on the left, and we have all the steps we need to go through for each method. We're going to work through that on a second whiteboard. Okay, so let me just transfer the information here. Just a perpetuity. Their tax rate's going to be 30%. And then we have no depreciation, CapEx, or net working capital. So put all that together, what's the free cash flow going to be? It's going to be EBIT times 1 minus T. All these other pieces just drop out. So that's 10 times 1 minus 0.3. So we have a $7 free cash flow in perpetuity. As simple of a firm as you can think of. Okay. What other data do we have? We know that RU is 10. This is the discount rate on the assets, the discount rate on the unlevered firm. And we know that if they raise debt, the discount rate on the debt is going to be 5%. And that's all the information we have here. We want to value this company using each of those three methods under each of these three capital structures. So first, let's do it with 100% equity. The first method is going to be the weighted average cost of capital. So we look on the whiteboard on the left. How do we value a company with the weighted average cost of capital? We discount the free cash flows by the WACC, and that's it. Okay, so what are the free cash flows? Well, we have those. Those are $7 in perpetuity. We need to discount that by the WACC. What is the WACC? Well, we know, okay, it's debt over value. Okay, we have the equation over there, so I'm not going to rewrite it. If the company has 100% equity, then we look at the WACC formula. Well, there's no debt, so this thing is 0. Okay, so the WACC is going to be 0 for debt plus, it's 100% equity, so 1 times RE. The question is, what is RE? Well, again, if it's 100% equity, then we know from the balance sheet identity, assets are equal to debt plus equity. So the assets are just equal to the equity if it's 100% equity. So therefore, the return on the assets is equal to the return on the equity. So the return on the assets is RU, right? That's the return on the operations of the company. It ignores financing. So if we don't have any financing effects because we don't have any debt, then RU is equal to RE, which is just 10%. So the WACC is going to be 10%. The value of the company, therefore, is a perpetuity of the free cash flows divided by the WACC. Free cash flows are 7, the WACC is 10%, so the total value of the company is 70. All right, so that's 1 out of 9 valuations. Let's do it again. Same thing with the APV now. We look down here, these are the steps for the APV. We're going to go step 1, find the value of the company without any debt by discounting the free cash flows by RU. We know that the free cash flows are a perpetuity. We just have to discount them by RU to get the value of the unlevered company. So again, the free cash flows are 7, RU is 10%, that was given. So the value of the company with no debt is 70. What is the value of the interest tax yield? If it's 100% equity, then it's nothing, right? We don't get any interest tax yields if we have all equity. So the value of these tax yields is 0. Therefore, what is the total value of the company? It's the value of the company without any debt plus the value of the tax shield, so that's 70 plus 0, which is 70. Okay, same thing we got with the WACC. Right, the steps look different. We're just being very systematic in how we approach these problems, so we're kind of following these steps to a T. So they look a little bit different, but not surprisingly, we're going to get the same answer. Last method is flow to equity. We know that we need to discount the free cash flows to equity by RE. What is RE? Fortunately, we already figured this out with the WACC. We already talked through this. We know that the company has 100% equity, so it has no debt. So what is the return on the equity? Well, it's going to be the return on the assets. Right? Same exact logic that we did with the WACC. So we have that. The last thing we need for flow to equity is to calculate the free cash flows to equity. Let's just to remind ourselves, let's go down on the whiteboard here. Let's pull up the steps for flow to equity. We're discounting the free cash flows to equity by RE. Here's the free cash flows to equity. We know that the free cash flows are 7. That's the first ingredient for the free cash flows to equity, is those free cash flows. With 100% equity, what are you doing on the financing side? Well, you have no interest payments, so this is 0, and you have no new borrowing, so that's 0. So the free cash flows to equity are just 7 minus 0 plus 0, so that's 7. And again, that's in perpetuity because the free cash flows are in perpetuity. Put all that together, what's the value of the company now? We're going to discount the free cash flows to equity by RE. That's 7 divided by 0.1. Well, what do you know? That's $70 again. Okay. The mechanics here look the same for each of these methods. It all boiled down to 7 divided by 0.1. That's 70. But notice that we were calling stuff by different names in each of these methods. With the WACC, it was the free cash flow divided by the WACC. For APV, it was the free cash flows divided by RU. For flow to equity, it was the free cash flows to equity divided by RE. It just so happens that all these things are the same when we have 100% equity. Right? If you have no debt, then things are very simple. All these different variables mean the same thing. But that's not always going to be true. So when we change the capital structure, we'll see that there will be a difference between these calculations. But again, as long as we follow the steps very carefully, we'll still get the same answer. Okay, so let's look at the second example now. So we value this company 3 ways. We're going to change the capital structure and do it again for each of those 3 methods. Now the company's going to have 50% debt and 50% equity. Erase these to give us more space. But not only does the company have 50% debt and 50% equity, we need to say something about the capital structure going forward. So if we pull up the slides again, we need to say something about how it will evolve, how the capital structure will evolve. In the second case, we're going to keep the debt to equity ratio constant, so that as the assets grow, you have to take on more debt to keep that ratio the same. Let's value this company with WACC again. We pull up our steps. We need to calculate the free cash flows. Well, that's already done. Right? The free cash flows don't change based on our capital structure. So that's a useful note. The free cash flows are just from the operations. So whatever you do to your capital structure doesn't affect those. So when we use the WACC method the second time, the free cash flows don't change. Well, what is going to change when we change our capital structure? Well, we know that the discount rates are going to change. As you take on more debt, the equity becomes riskier. And so the equity discount rate is going to change, these ratios are going to change, and we're going to get a new WACC. We can't forget to relever the equity. Before, we had the discount rate on the equity was 10% because we didn't have any debt. But if we take on debt, now the discount rate on the equity is going to change. So recall the relevering formula. This is the very, very general formula that we derived when we studied delevering and relevering. So this is just algebra. This is working through the balance sheet identity in terms of returns and solving for RE. We made this assumption that debt over equity is going to stay constant going forward. That's going to be very important for our relevering equation. Okay. So recall that if debt to equity is stable, then what did we get? We get that the risk of the tax shields is the same as the risk on the assets. Assets grow, you have to take on more debt in order to keep your debt to equity ratio the same. That means we're able to just drop off this last term. We're able to relever, ignoring all of this stuff with the tax shields. We don't need to think about that. We were only able to drop that off because debt to equity is constant, right? These two things are the same. That means that we have RU minus RU, that's 0. So I'm just going to get rid of all that. Now we can relever the company. The discount rate on the equity is now going to be RU, which is 10% plus debt over equity. If it's 50% debt and 50% equity, then what's the debt over equity ratio? Well, it's 50% debt, 50% equity, so that's just 1, right? The debt to equity is going to be 1. RU is 10, and RD was given as 5. We were given those to begin with. So that means that the discount rate on the equity is now 15%. That's going to allow us to recalculate the weighted average cost of capital. Before it was 10, but now it's going to be different. What's debt over value with this new capital structure? Well, again, if it's 50% debt, 50% equity, one way you could do this is, well, it's 50% debt divided by debt plus equity. 50 parts debt, 50 parts equity. So it's going to be 1/2. What's the discount rate on debt is 5, and then the tax rate is 1 minus 0.3. It's half debt, it's going to be half equity, and the discount rate on the equity is 15%. I'm just working through this WACC equation left to right. Half debt, half equity. Cost of debt is 5, tax rate is 30%, cost of equity is 15. You run that through your calculator, and you'll get a WACC of 9.25. So the last thing we need to do is discount these free cash flows by our new WACC. This equation looks the same because the free cash flows are still perpetuity, so it's still going to be 7. The only thing that changed when we change our capital structure is our WACC. So we put that together and we get that the new value of the company is 75.68. Used to be 70, but now it's 75.68 when we take on debt. So those are the steps. Again, we just have to be very kind of careful, very just a procedure that we have to follow. Find the free cash flows, find the WACC, put the two together to get the value of the company. What are some interesting implications from this? Well, one thing, if the company is 75.68 and it's half debt, well, that tells us how much debt we should be taking. Debt is 1/2 of the company. The company is 75.68. So the total value of the debt should be 37.84. The other interesting implication is that we know how much the value of the company changed. It went from 70 to 75.68. So what does that tell us about the value from financing here? It tells us that the tax shields are worth 568. We can figure that out implicitly. Recall that all the WACC is doing is it's pushing the discount rate down so that the valuation goes up by the amount of the tax shields. So if our valuation went up by 568, that tells us that those tax shields were worth 568. Let's move on to APV now. We're going to, again, solve the same exact problem with APV. We're going to, again, just try to follow these steps as closely as we can. The first step for APV is to discount the free cash flows by RU. That's going to give us the value of the company without any debt. Notice that neither of these things change with our capital structure. Nothing in this step is going to change with our capital structure. The free cash flows are from the operations, so that's not affected. RU is, again, the discount rate on the assets from the operations, so that doesn't change with your capital structure. So this step's going to be the exact same no matter what capital structure you use. Free cash flows are still going to be a perpetuity of 7. RU is still going to be 10%. So just like last time when we had 100% equity, the value of the unlevered company is still going to be 70. Nothing changed here. What will change is that we have to now separately forecast the tax shields. We have two things that we have to think about now. First, we have to find what those tax shields are. And then second, we have to decide what discount rate to use. We talked about the discount rate a little bit above. We said that because debt to equity is stable, the discount rate on the tax shield should be RU. We needed that to re-lever the equity. So we're just going to take that argument again and recognize that when we discount in APV, when we discount those tax shields, we're still just going to use RU. Okay, so we have our discount rate for part 2 of APV. The last thing we need to do is forecast the tax shields. Recall that you can calculate the tax shields as the level of debt times the interest rate on the debt times the tax rate. So we have all this information. We know that the company is going to have to raise $37.84 in debt. We figured that out with the WACC method. With APV, you need to know how much debt you're going to have. You need to know how to get your tax shields. So we needed that at some point. If it's here we got it from the WACC part, but I have to give this to you for an APV problem. You need to know how much debt you have. We know that the return on the debt is 5. That's our interest rate. And we know that the tax rate is 30%. That means that the interest tax shield is going to be 56.8 cents. And like the free cash flows, this is in perpetuity. If the assets are just perpetuity and you're having a constant level of debt, constant debt to equity ratio, if the assets aren't growing, then you expect that the debt is going to stay the same. Like the free cash flows are just a constant $7, $7, $7. So that means that the value of those assets is staying the same. With a constant debt to equity ratio, that means that the level of debt has to stay the same. So that interest tax yield is going to be a perpetuity, just like the free cash flows. So we have a stream of cash flows now of 56.8 cents. We have a discount rate for those cash flows, so we can put those together to value them. The value on the tax yield is going to be the tax yields divided by the discount rate on the tax yields, just our old perpetuity formula. 56.8 divided by 0.1, that tells us that the value of the tax yields is going to be 568. And this should look familiar to us. We saw that when we did the WACC, the value rose by 568 because of the tax yields. So it's good that when we do APV, that's also what we're getting. Right? The calculations are different. We got this 568 a different way, but we kind of knew ahead of time that this should be the answer. Okay, so the final part for the APV problem is to add up VU plus VITS. So it's 70 plus 568. That's 7568. Steps look different with the WACC, but again, we just have to be very kind of precise and follow the procedure, follow the steps, and we'll get the right answer. Okay. Last method is flow to equity. And this one's going to look the most different. We're going to follow the same steps. We have to calculate the free cash flow to equity and discount those by RE. Part of the work is already done. We already figured out what RE is. We re-levered the company for WACC above. So that stays the same. We found that the discount rate for the equity is 15%. We're going to need this for flow to equity. We could have done it down with flow to equity, but we already did it for WACC, so I'm just going to keep that. So we already have that. The only other thing we need then is to figure out this free cash flow to equity business. So what happens at time 0? The company has raised debt. We know how much debt they rose. It was $37.84. Just like we needed to know how much debt you have to calculate the tax yields for APV, you need to know how much debt you have to calculate the free cash flow to equity for flow to equity. Okay. What is the free cash flow to equity at time 0? There's no free cash flows. The free cash flows were that perpetuity of 7 starting in a year. That's how we've treated this for all of the other 5 times we valued the company. It's just 7 in a year, 777 is a perpetuity. So at today, at time 0, there's no cash flow. How much interest is there at time 0? Well, if we just raise the debt, then there's no interest, right? It takes time for interest to accrue, so there's still no interest. The only thing that happened at time 0 was we raised debt of $37.84. So that's our free cash flow to equity at time 0. Just walking through this formula very carefully. 0 free cash flow, 0 interest, just some new borrowing. What happens going forward? Time 1 to infinity, because this is a perpetuity. This company is a perpetuity, so we can calculate it at time 1. It's going to be the same going forward. We're going to get those free cash flows, and we have to pay interest on the debt. We're going to keep the level of debt constant again, just like we kept the debt constant for the APV. We know that if the assets are a perpetuity, we have to keep the debt to perpetuity to keep debt to equity stable. So it's all going to be a perpetuity, but we need to figure out how much that's going to be. We're going to just walk through this formula again. The free cash flow is 7. Our tax rate is 30%. Next, we have to find out the interest payment. We did some of this up above. We know that the interest tax yield was debt times the interest rate times the tax rate. We know that debt times the interest rate, that's the interest expense. That's how much you have to pay in interest each period. So we can figure that out. If we had $37.84 in debt, and the rate was 5%, and the interest payment was $189. That's what we put in our free cash flow to equity formula. And because everything's a perpetuity, we're not going to borrow any more money going forward. So our level of debt is staying the same, just like with the APV. No new borrowing after time 0. So going forward, nothing. That means our free cash flow to equity is going to be 568 in perpetuity. We're almost there. We know that we need to discount the free cash flow to equity by RE to get the value of the company. That's what flow to equity tells us to do. These are the free cash flows to equity. We have a different one at time 0, and then we have a perpetuity of free cash flows to equity starting at time 1. The discount rate on the equity was 15%. Put all that into your calculator and kind of guess what you're going to find. You're going to find the same answer, that the value of the company is $75.68. These numbers look a lot different, right? The calculations look a lot different with flow to equity than they did with the WACC, and it looks a lot different than the APV. But you just follow the steps. You have to be very careful in calculating the free cash flows to equity in particular here. But if you get those down, then you're going to get the same answer for each of the methods. Okay. The last capital structure we said we wanted to do was still 50% debt, 50% equity. But now we're going to keep the level of debt constant going forward. Instead of having a constant debt to equity ratio, we're going to keep the level constant. What's that going to do? We know that the tax shields depend on, the risk of the tax shields depend on what's going on with our capital structure going forward. So that's the thing that's going to change here. The risk of the tax shields is going to change when we change this assumption about the evolution of our capital structure. That shows up in a couple different places. So when we relever, for example, we need to know the discount rate on the tax shields. Likewise, when we do APV, we need to have a discount rate for the tax shield. So it's going to show up in those two places. So let's spell this out now. We value this company 6 ways now, with 100% equity, 50% debt, 50% equity, with a constant debt to equity ratio. Now we're going to do it 3 more times, half debt, half equity, but now the level of debt is going to stay constant. Rather than growing and shrinking with our assets. Okay, so for the WACC method, we need to calculate the free cash flows, discount them by the WACC. Free cash flows, again, don't change. Those are from the operation. So whatever you do with your assets or whatever you do with your capital structure doesn't change your free cash flows. You still need to recompute the WACC. However, we're not going to be able to use this very simple relevering formula anymore. Here's our very general formula. If we have a constant debt, then what we're left with is the risk of the tax shields is RD instead of RU. Okay, so this is the one thing that changes. When we change this assumption about our capital structure, the one thing that changes is the discount rate on the tax shields changed from RU to RD. That means we can rewrite this relevering equation. It's not going to look like this anymore. What we'll do, and we derive this in the delevering and relevering notes, but what we'll do is we'll just multiply this by 1 minus t. You can double check the relevering notes to see this. Don't worry about this formula. We're not going to focus on this going forward. This is just an illustration that the relevering depends on what's going on with your capital structure. And in this very particular case, this is a very special case where the debt is a perpetuity. Okay. If the debt's a perpetuity and you're not going to move it around, then you get this relevering equation. Okay. It's a very particular case, so don't worry about memorizing this. Don't worry about putting this in your notes or anything, because we're not going to use it on a test or in real life. It's a special case where you have a perpetuity of debt. We get this relevering equation. So then we add that 1 minus t term here. When we relever, we lower this by 1 minus 0.3. That gives us a discount rate on the equity of 13.5% instead of 15%. This should make some sense. The risk of the tax shields went down. The risk of the tax shields used to be 10, but now they're only 5%. That means that the cash flows for the equity holders are now safer. Right? If the tax shields are safer, that means that the equity cash flows are also safer. So that the required return on the equity went to 13.5 from 15. Okay, so that was a good thing for the equity holders to make the tax shield safer. That discount rate on the equity then shows up in the WACC. Instead of 15%, now it's 13.5%. That's going to give us a new WACC. Instead of 9.25, the WACC becomes 8.5. The general steps are all the same. We still had to relever. We still had to recompute the WACC. But just this relevering step was different, and that feeds into the WACC down here, which then feeds into the value of the company. The free cash flow is the same again at 7, but we recomputed the WACC at 8.5. So that tells us that the new value of the company is $82.35. It used to be $75.68, now it's $82.35. And that should make sense to us because the tax shields are safer. The tax shields are safer, the value of the company goes up. So that's why we got that extra kind of $7 from it. So how much debt are we taking now? Well, now we're taking half of $82.35. So that's going to be $41.17. And now the value of the tax shields went up. It used to be 5. Now the value of tax shields we have a sense should be about $12.35. Again, because the tax shields are safer, so the value goes up. So that's WACC. Relevering was different now. The steps were the same. The relevering was a little different. That just fed into all these other calculations. Let's do the same thing with APV. We still have this constant level of debt, so we're still going to use the discount rate on the debt as the discount rate on the tax shields. So move down to APV. We're going to follow the same steps. We have to discount free cash flows by RU. Like we mentioned before, this doesn't change with capital structure, so that stays 70. We don't have to do anything new here. We do have to discount the tax shields by RITS. That means we have to change some stuff now. Since our capital structure evolution is going to be different, the debt level is going to be stable. That means that we're going to use the risk of the debt as the risk of the tax shields, which is 5%. Okay. What else changes? Well, the level of debt changed. We calculated up here that the company is now going to take on $41.17 in debt as opposed to $37.84 before. That's going to feed it into our tax shields. The interest rate's the same, the debt goes up, the tax rate's the same, so that means that the level of our tax shields is going to go up a bit. In particular, our tax shields are going to be 62 cents per year instead of 56.8. We're keeping debt constant, so that means that the tax shields are still going to be a perpetuity. So we need to use our perpetuity formula to value those tax shields. But now the risk of the tax shields is not 10%. We said it's 5% because the evolution is different. And likewise, we calculated a new tax shield of 62 instead of the 56.8. That means that the value of the tax shield is going to work out to $12.35. Kind of already knew this answer when we looked at how the WACC changed, but it's good to explicitly model those tax shields and get that number. So then last step of APV, you add up the value without any debt to the value of the tax shields to get the 82.35 that we got before. So now we've valued this company 8 ways. We got to do it one more time. We have to calculate the flow to equity method using this last capital structure where we keep the level of debt constant. First things first, we need to figure out the return on the equity. Well, again, we already did that with the WACC. We did all this relevering business to figure out that the discount rate on the equity should go to 13.5% under our new capital structure. So we just pull that down here. What happened at time 0? The company raised debt again. It didn't raise $37.84 anymore. It's going to raise the $41.17. That's going to give us our free cash flow to equity at time 0. Just like before, it's just how much debt did we raise. It was $41.17 now instead of the $37 before. Last thing we need to get is the free cash flows to equity at time 1 and going forward. That's still going to be a perpetuity. But again, the level of debt changed. The interest rate on the debt is still 5%, but that means that the interest payment is going to go up. The interest payment is going to be $206 now. We plug that 206 into our free cash flow to equity formula. That gives us a new free cash flow to equity of 556. Finally, discount all those free cash flows to equity by the return on the equity. Free cash flow to equity at time 0 is $41.17. Free cash flow to equity going forward in perpetuity is 556. And now the discount rate on the equity is 13.5 instead of 15. So you put all of that into your calculator, and you can bet dollars to donuts you'll get the same 82.35 that you got before. So let's review, kind of take a big step back. What changed from when we changed our assumption here? The main thing that changed was our relevering. By changing our relevering formula, that fed into everything below it, right? That fed into the WACC. which fed into the value of the company, which fed into how much debt you take. So that means that your tax shields went up. That means that your interest payments also went up. So that was the primary driver. If you change your relevering, it's going to affect everything downstream. The steps below that were exactly the same, though. Right? All the steps we did for WACC were the same after that relevering. All the steps we did for APV were the same. All the steps we did for flow to equity was the same. It's also a little bit amazing that we can get the same answer using these methods that look so different. Right? This stream of cash flows here, 4117 plus a perpetuity 556 at a discount rate of 13.5, that just looks way different. You would not have any expectation that that would equal the same thing as what we're getting with APV. It just kind of works out. It's the algebra that's going on behind the scenes that makes this work. But it's a little bit striking the first time you see it. Okay, so we've exhausted this problem. We've done it 9 different ways, 3 different types of capital structures and 3 different methods. Hopefully you start to see the steps, you see the patterns. Each method has kind of distinct steps you take. Just be very careful in following those steps and you'll get to the right answer. What I want to talk about next is why it may be kind of better to use one method or the other. So the next example, we're going to see that WACC is going to be very easy to use if we keep debt to equity constant. It's a somewhat complicated example, but WACC is going to be real nice. These other methods are going to be very difficult to use because you have to keep track of all the debt going forward. But the WACC is going to be easy. Before we get to that, I want to bring your attention to this table. This table summarizes our 3 methods. So we've got the whiteboard here, which walks through it. I try to translate all this information on the whiteboard for each of these 3 methods into one table here. So every WACC problem, you get the free cash flows and you discount them by the WACC. Every APV problem, you get the free cash flows, you discount that by RU, and then you separately forecast the tax shields and discount that by RITS, where RITS could be one of 2 things. It could be the risk of the assets, or it could be the risk of the debt. Okay, these are the 2A and 2B. And then finally, flow to equity method, you have to calculate this free cash flow to equity and discount it by the discount rate for the equity. So hopefully that's a nice way to summarize all of these steps. So let's get to the kind of mini case example next. This slide foreshadows what's going to happen with this example. We're going to have a constant debt to equity ratio, and we'll see that WACC works very well. It's very easy to use it. Conversely, APV and the flow to equity method are going to be more work. Now, why are they more work? If we go over to our whiteboard here and we think about all the steps for APV and flow to equity, well, if everything works well with WACC, it's pretty easy. You just forecast the free cash flows, discount them by the WACC, and you're done. With APV and flow to equity, however, we need to keep track of the debt. Period by period, we need to know how much debt we have so that we can calculate the tax shields, for example, with APV. For flow to equity, we need to keep track of the debt so that we can forecast the interest payments going forward, period by period. Right? We didn't have to bother with any of that with the WACC. Everything in the WACC gets kind of cleanly incorporated in the discount rate if we keep the capital structure stable. Okay. So here's a bunch of data for the free cash flows for this company called Avco. They're thinking about introducing this new line of packaging. We're going to walk through the free cash flows, and then we're going to calculate the discount rate for the company, and then we're going to value them. Okay. We'll do this first with the WACC because that's going to be the easiest approach, but then we'll also do it with APV and flow to equity, and we'll see exactly what we need to do that's more complicated there. We've got a little table set up already for Avco's free cash flows for this project. With this new line of packaging, it's going to generate cash flows for 4 years. Okay, so you create this new technology, you're going to use this, but it's going to become obsolete in 4 years. So that's our timeline. We go from time 0 today to year 4. Sales are going to increase by 60 million per year if we take this product. Okay, and that starts in a year. Okay, so I'm just going to look at this table here. Our revenues are going to go up by 60 million in years 1 through 4. That's the first bullet point. Next point, we say that the manufacturing costs and the operating expenses are going to be 25 million and 9 million respectively per year. Again, if we invest in this thing, right? So I already have a row here. These are our operating expenses, so they're part of our EBIT, right? We've got revenue minus our expenses gives us our EBIT. So we filled out the top line of revenue. Now we're moving down to the expenses. We've got 25 in manufacturing expenses each year. And then we'll have 9 million in operating expenses each year. Moving down to the next bullet, we need a upfront R&D and marketing expenses of 6.67 million and a $24 million investment in CapEx, in equipment. Okay, so that's upfront. That's today times 0. We have to make this expense. So R&D and marketing, we're going to put that at 6.67. And R&D and marketing are all together, so I don't need an extra line for that. Okay. Then nothing in R&D going forward, right? We have to make the research today, and then we figure it out. We don't have to expense that later on. It's just something that happens today. The $24 million in equipment, that's a long-lived asset. So something like R&D and marketing, that gets expensed right away. Today, you spend the money, it's expensed. With equipment, it's PP&E, right? Plant, property, and equipment. We said that that's a long-lived asset. So that's going to get depreciated over time. It requires 24 today. That's our CapEx of 24 million. And then this subpoint says that it's going to be obsolete in 4 years, and we're going to just depreciate it straight line for 4 years. So if the investment was 24 and you're cutting it up in 4 pieces, then that means each year you're depreciating it $6 million. So our depreciation expense is going to be 24 divided by 4, which is 6. And that occurs for each of the next 4 years until the book value of this thing goes all the way to 0. There's going to be no net working capital. So if we're just walking through our free cash flow equation, we need to get the EBIT, depreciation, CapEx. We have all of those pieces together already. And then we just say, for simplicity, no increases in net working capital. So just a bunch of zeros here. And a tax rate of 40%. We put all this together to get the free cash flows. So what's happening at time 0? No revenues, none of these manufacturing operating expenses. We just have that R&D and marketing of 6.67. So our EBIT is going to be minus 6.67. Our NOPLAT then, with a 40% tax rate, is going to work out to be minus 4. 60% of minus 6.67 is going to be minus 4. That gives us a free cash flow at time 0 of minus 4 minus 24, so minus 28. Again, just working through the free cash flow equation. We've done this before, but it may be a little bit rusty. We don't have any depreciation at time 0, so it's just our NOPLAT minus our CapEx. Okay, how about times 1, 2, 3, and 4? The nice thing is all of these numbers are the same for years 1 through 4, so we just got to figure this out one time, and then we know that it will be the same for each of those 4 years. First, let's figure out our EBIT. We know that our EBIT is our sales, revenues, minus our operating expenses, and then also minus depreciation on top of that. So we've got 60 minus 25, now we're down to 35, minus 9, so now we're up to 26, minus 6, that gives us an EBIT of 20. We take away 40% of that in taxes. That means we're left with 12. And that's going to be the same for each year. No CapEx going forward. We just have the CapEx today, and no net working capital. Putting together the free cash flows, we have our EBIT, and we have our depreciation. These are the 4 ingredients for free cash flow, so those are the only things we need to focus on at the end of the day. So at time 1, we have our NOPLAT of 12 plus depreciation of 6. That means we have a free cash flow of 18. And that again is the same each year. All right, so nothing new here. This is all free cash flow stuff. It's good to practice a little bit more with this, even if it's not the focus of our lecture. What we're going to do next is value this. So if we have the free cash flows and we want to use the WACC method, we need to compute the WACC. We need to get a discount rate in order to value these things. That's what we're given next. We're giving information on their balance sheet as well as their cost of capital. So here's the assets. They've got $20 in cash, $600 in existing assets. Their debt's $320, their equity's $300. The cost of debt is 6, cost of equity is 10%. Okay. So we want to value this project using WACC. That means we need to discount the free cash flows by the WACC. We figured out the free cash flows, we just got to figure out the WACC now. If we're given this market value balance sheet, then we can work through the WACC. What are we going to use for debt? Well, we look here and we see, well, debt's worth $320. One thing we have to remember from the WACC slide is that when we compute the WACC, we're really using net debt. The reason is the WACC is trying to get the discount rate for the operations. If you use the average discount rate on the debt and the equity with these numbers, that's going to give you the weighted average return for all of the assets. Like the weighted average return for all of the debt and equity gives you the weighted average return of all of the assets. But we're not interested in the return on the asset, on the cash. We only want to know the required return on the operations for the company. So to get at that, we need to get rid of the cash on the asset side. So that's why we talked about this business of computing net debt. This is just a reminder of that then. We've got 320 in debt, but 20 of it is in excess cash. So our net debt is going to be 300. What's the total value then? Well, our net debt is 320 minus 20. And then our equity is 300. So we have a total of 600. That's the total value, $600. That's the total value of all of our operations. We multiply that by the cost of debt, which is given at 6% in this little table. And we multiply that by 1 minus our tax rate, which was given at 40%. We use that here to calculate the EBIT. All right, moving on to the equity side, the equity is worth 300 out of the 600, and the cost of equity is given at 10%. Putting that together, we'll get a weighted average cost of capital of 6.8%. We have the free cash flows, we have the WACC. Now we just put them together to get the NPV for this project. The free cash flow at time 0 is minus 28. And then we have this annuity. We have $18 in free cash flows every year for 4 years. It occurs at fixed intervals. So we have the annuity formula here. You plug all that into your calculator and you'll get an NPV of $33.25. And that's it. We did a fair amount of work to calculate these free cash flows. It wasn't anything new about that, but that was a fair amount of work. It took a minute to figure out the WACC. We had all the information here. We just had to work through the details to get the 6.8. You get the free cash flows, you have the WACC, and then you're done. You just discount, and you get the total NPV of $33.25. Done. Now, what's going on underneath the hood? In order to use the WACC, we needed to have that this debt to equity is going to stay constant. We just figured out, though, that the total value of the company goes up, right? The NPV of the project is $33.25. That means that if you take this, the value of the company has gone up. To keep debt to value the same, then, that means that we have to be taking on more debt. That's going on underneath the hood, right? We didn't have to bother with that. We didn't have to calculate how much the debt increased. But that's kind of implicitly what's happening. So that's on this slide here. This is this hidden assumption that you have to be taking on more debt in order to keep that capital structure constant. In particular, as soon as you take the project, your future cash flows are going to go up by $18 for 4 years. Okay. That's the annuity component here. So that amount is $61.25. If we want to have 50% debt, 50% equity, which again, that's what we had in the balance sheet when we calculated the WACC, right? We saw that we had half debt and half equity. 300 out of 600 was equity. 300 out of the 600 was debt. If we want to keep that the same, then as soon as we take the project, the future cash flows go up in value by $61.25. That means our debt has to go up by half of that. Just 50% of those future cash flows, that value of $61.25, half of that's got to be now in debt. That's where APV and flow to equity are going to be a little bit more complicated. So take a step back before we proceed. What you should know how to do is you should know how to value a company like Avco. You should be able to value this project using the WACC. Just get the free cash flows on the WACC and you're done. you should understand that the other methods, APV and flow to equity, are going to require us to more carefully track the level of debt. We're going to have to keep track of this amount over time if we want to implement APV and flow to equity. Now, don't worry about the details. I'm going to show you in the slides how this would work if you wanted to track the level of debt to compute the value through APV or flow to equity, how we could do that. Don't worry about the mechanics. I'm not going to ask you to do that in particular on a test. You should be able to do it with the WACC, but not necessarily with APV or flow to equity. Okay, so here's what we got to keep track of. We have to know how much debt we need in order to keep this ratio at 50%. We know the free cash flows, minus 28 today, and then 18, 18, 18, and 18. How much are those worth in present value terms? Well, like we just said, as soon as you take the project, your future cash flows go up by 61.25. So to keep your debt at 50%, you need to have 30.62. You do the same thing going forward. So at time one, what do your future cash flows look like? Well, at time one, you've got 18, 18, and 18 for the next 3 years. Those are worth 47.41 to you sitting at time one. So that means that your debt level now has to be 23.71. You have to have a 23.71 more in debt at time one than you do today in order to keep your capital structure at 50%. Right? Likewise at time two, at time three, you've got one cash flow in the future, that's $18. How much is that worth in time $3? That's $16.85. Right, just discount that $18 one time at our WACC of 6.8%. That's 16.85. That means you need to have debt in time three of 843. You need to have 843 more in debt today than before you took the project. And then finally at time four, the project's done. You're not going to get any more cash flows from this project after time four. So what does that mean? That means that your debt returns now to the level that it was before you took the project. Right? If I don't have any more future cash flows from this project, then I'm not going to have any extra debt on account of the project. Okay. So essentially what's going on is we take on debt of 30.62 when we first start the project, and then we pay it off over time. We pay it off with those future cash flows to keep the level of debt at 50%. That means that by the end of the project, we paid off the debt that we issued for the project. We need this to value the project with APV or flow to equity. We pull up our steps for APV, for example, and we need to figure out the tax yields. We need to forecast those tax yields. Well, how can we forecast the tax yields? Well, we need the level of debt. Okay, so let's go through that. Let's just see, again, don't worry about the details here, but let's just see how you would do that if you wanted to use APV for this project. Well, the first step with APV is to find the value of the project without any debt. We need to discount the free cash flows by RU. Just as a reminder, how can we get RU? Well, that's the pre-tax WACC. Since our capital structure is stable, RU is going to equal the pre-tax WACC. This is again something we saw with delevering and relevering. We've seen it a couple times now. We computed the WACC above here. That was 6.8%. I'm going to copy that down here, but now it's just going to be the pre-tax WACC. So we get rid of this 1 minus t term. It's going to be half debt at 6%, half equity at 10%. So that means we're going to have an 8% pre-tax WACC. That's going to be RU. The value of the project without any debt, therefore, are the free cash flows, which was, just as a reminder, is minus 28. It's in the slides here, so you don't need the reminder. It's minus 28 at time 0 plus this annuity of $18 discounted at a 8% rate now. The value of the project without any debt is then $59.62. The second part of APV is to find the value of all those tax shields. What discount rate should we use for the tax shields? Well, again, we have this thing that we figured out from delevering and relevering. If debt to equity is going to be stable, then the risk of the tax shields looks like the risk of the company, which is going to be that 8%, the pre-tax WACC. We still need to forecast the cash flows, or we still need to forecast the tax shields. But once we forecast the tax shields, then we have the rate already of 8%. We discount the tax shields by the 8% and then add those to the 59.62. We have everything we need to get the tax shields. We have the debt. We know the debt has to follow this trajectory in order to keep our capital structure stable. We know the interest rate we're paying on the debt is 6%. And we know our tax rate is 40%. So to calculate the tax yield, we're just going to use our kind of old trusty formula. It's going to be the debt level times the interest rate times our tax rate. It's going to be debt times 6% times 40%. What's tricky here is that the debt is changing over time. We don't have a constant level of debt. It's going down as the project goes through. So what does it work out to be? That's all summarized in this table here. We've got the level of debt that we already saw. We have to calculate how much interest we're paying on the debt at each period. So this 30.62, you multiply that by the interest rate of 6%. That gives you 184. We paid 184 in interest in that first year. We paid 142 in interest in the second year, 98 cents in the third year, 51 cents in the fourth year. How much does that save us in taxes? We multiply that interest payment by our tax rate of 40%. So we're getting a tax shield of 73 cents at time 1, 57 cents at time 2, 39 cents at time 3, 20 cents at time 4. That means we can value these tax shields. We've got 73 cents in a year. We discount that at 8%, which was our RITS. Then we have 57 cents at time 2. We discount that at 8% twice. Then we have 39 cents in year 3 and 20 cents at time 4. So you put all that into your calculator and you'll get 1.63. Last step with APV is to combine our steps. So what's the total value of this project with debt? It's going to be the value of the project without any debt plus the value of the tax shields. So we get the 59.62 from step 1 plus the 163 from step 2. And that works out to the same 61.25 that we found with the WACC. So we had and then we have to subtract off the sorry, this was minus 28 plus 59, excuse me. So VU worked out to be $31.62. I apologize. I didn't take out the initial investment of 28. So this was 3162. And then we add the 163 on top of that. And that gives us the 3325, which is the same that we had with the WACC. If we go up to the WACC valuation, we get this 3325. We replicated that now with the APV, following the steps carefully, or not so carefully in every place, but if we follow the steps correctly, we'll get the same number. But you see the difficulty here with APV is that we had to keep track of this debt capacity. We had to keep track of how much debt we have at each point. With WACC, we didn't have to do that. It was kind of implicit, it was under the hood, but we didn't have to bother with those mechanics. Same thing with flow to equity. So let's now use flow to equity to value this project. Well, the nice thing with flow to equity is we already have the discount rate on the equity of 10%. We just need to find the free cash flows to equity. We get those things, we discount them by the discount rate on the equity, and we're done. Just like our tax shields were changing every period, our free cash flows to equity are going to be changing now. Why? Well, the interest is changing. Right at time 1, we had 184 in interest. That's going to show up in the free cash flow to equity here. At time 2, we were paying a different amount of interest. So that's going to show up, again, as a different free cash flow to equity at time 2. Further, our debt is changing as well. So that means our net debt issuance is going to change when we use the flow to equity method. At time 0, we had to raise debt. We had to raise 3062. That was our net debt issuance. But then we said that we're essentially paying off the debt over time. That means that our net debt issuance is going to be a negative number. We're going to be paying it off and reducing our debt. That's now money that the equity holders can't touch anymore because we're paying back the bank. So we have to take that out from the free cash flows to equity. Okay, so just to put this in a table and see how it looks. The same four periods. We know what the free cash flows are. It's going to be minus 28 at time 0, and then 18, 18, 18, 18. We know what the interest payments are going to be. We calculated those here when we were getting the tax shields. We know that the interest payment is going to be 184 at time 1, 142 at time 2, 98, and 51. That means we can solve for the 1 minus t times the interest. If you multiply each of these interest payments by 60%, you'll get 110 at time 1, 85 at time 2, 59 at time 3, and then 30 at time 4. The last piece of the free cash flow to equity puzzle is this debt issuance. How is our debt changing? Well, at time 0, we said we had to raise 3062 in debt. Okay. And what happens at time 1? Well, now our debt is at 2371. So we ended at 2371. We started at 3062. Okay. So how much did our debt change? Our debt went down by 692. That's just the change in our debt level. We started at 3062, we ended at 2371. That means that we paid off 692 in debt. That's cash flow that now the equity holders can't touch. Do the same thing at time 2, time 3, and time 4. At time 2, we're still paying off our debt. We're going to pay off 739 in that second year. We're going to pay off 769 in that third year. And then 843 in the fourth year. Now we have everything we need to calculate the free cash flows to equity. You start with the free cash flows up here. You subtract off this 1 minus t times the interest, and then you add this net debt issuance. So at time 0, the free cash flows to equity is going to be 262. Free cash flows here, minus 28, plus net debt issuance, that gives us 262. At time 1, we have a free cash flow of 18. Then we have to subtract off the 1.1 in interest. And then we have to add the negative 6.92. So the equity holders then can get 9.98 at time 1. Okay. Just free cash flows minus the 1.1 minus the minus 6.92. Do the same mechanics at times 2, 3, and 4. We'll get the free cash flow to equity of 9.67, 9.76, 9.52, and 9.27. Putting this all together, these cash flows look very different than what we've seen before, right? With APV or with the WACC, we just had a very nice annuities of $18. These don't look anything like that. But let's see what happens when we discount these. The value of the project, according to the flow to equity method, is going to be the discounted free cash flows to equity. So we have 2.62 today. Then we have 9.98 in a year. And we have to discount that at 10%. Because again, we're discounting at equity now. Not the WACC, not RU, equity. Then we have 9.76. That's in 2 years. 9.52 in 3 years. And then 9.27 in 4 years. Very ugly numbers, but you put this into your calculator, and what do you think we're going to get? We'll get the 3325. Same exact answer that we got with the other two. The mechanics look very different, but it all kind of works out. The algebra all works out. This is all worked out in the slides. Here's valuing the tax shield separately. Now here's calculating free cash flows to equity. I was using this as my cheat sheet when we were walking through this table. Again, cash flows look kind of crazy, but we get the same answer. Right. So with this example, this past example, you should see by now that if the assumptions of WACC hold, if you have a constant debt to equity ratio, then WACC is just much easier. You don't have to worry about what's going on with your debt. When we use APV, or flow to equity, we had to use like an extra page of work just to keep track of the debt. With WACC, we didn't have to do any of that. We're going to turn now to another example where we get the opposite implication. We're going to have a capital structure that's not stable. We're going to have a capital structure that's changing. And we'll see that in this case, you don't want to use the WACC. Because if you use the WACC, now you got to do all this extra work with relevering. On the other hand, APV is going to be like trivially easy because APV was built for flexibility. It's built to deal with changing capital structures. To foreshadow what's going to happen with this next example, if the capital structure changes, the discount rates are going to be changing every period. That's not going to be a problem for APV because with APV, the free cash flows and the return on the assets don't change with our capital structure, but the discount rate on the equity does and the WACC does. And what we'll be left with is a different discount rate for each period. And so each cash flow is going to have a different discount rate. And so we have to keep track of all of that when we use the WACC or the flow to equity method. But APV, we're not going to have to worry about. So let's set up the problem here. Just got some generic firm X. I set up the cash flows in a table. It's a very simple firm, just 2 periods, 2 cash flows in the future. You'll have a free cash flow of 400 at time 1 and a free cash flow of 200 at time 2. I just give those to you, and then the firm's going to cease to exist. The firm has some debt, and we're going to pay off the debt at the end of the first year. Okay, so we have some debt at time 0. I'm not sure what that is, but we're going to pay it off at the end of the year. So we're going to have 0 debt at time 1 and 0 debt at time 2. We're going to pay interest on the debt. The interest is going to be $15 that we pay at time 1. And then we'll also have a face value amount of $300. That's not going to show up in APV. We only care about the interest payments. But then once we pay off the debt, then obviously there's no interest at time 2. We're also given information on the discount rates. We know that RU, the discount rate on the assets, is 20%. And the discount rate on the debt is given at 5%. And the tax rate is 30%. Take this, and we're going to value the company using APV. It's going to be easy. Then we'll do it with the other methods. First step for APV, we've done this a few times. You find the value of the unlevered company by discounting the free cash flows by RU. We have the free cash flows already. We're given RU, that's the discount rate on the operations. So this is all going to be very easy to do. We have $400 at time 1. We discount those at 20%. We have $200 at time 2. We discount those at 20%. Put all that together to get $472.22. Second part of any APV problem, find the value of the tax shields by discounting the interest tax shields by RITS. First thing we should do is we should figure out what those tax shields are. We're given the interest payment at time 1 of $15. How much does that save us in taxes? Well, we know that the interest tax shield is the interest payment multiplied by the tax rate. Just as a review, interest payments is the interest tax shield. We could write this as debts times interest rate times tax rate. That's going to be the same thing as the interest expense times the tax rate. We're given the interest payment here of 15, so we just multiply that by the tax rate of 30%. We have an interest tax shield of $450. And then once we pay off the debt, obviously we don't get any more interest tax shields. We don't pay any more interest. So at time 2, we don't get any interest tax shield. The last thing we need to decide is RITS. Notice here that the capital structure does not move with the assets in any way. The debt, we're just going to pay it off at the end of the year. And that's regardless of how well the assets do. Right? The debt is not tied to the assets. If the debt is not tied to the assets, we said that the natural assumption is that the discount rate on the tax shields is the same as the discount rate on the debt. So the tax shields are not perfectly safe. You still need to pay off your debt. As long as you pay off your debt, you get the tax shields. So how risky are the tax shields? They're as risky as the debt. We know the discount rate on the debt is 5%. Okay, that was just given here. So we're done. We know the discount rate for the tax shields. We know the cash flows from the tax shields of 450. So we're going to discount those. We're going to put those two together to get VITS. It gives us the value of the tax shields of 429. Finally, we put all this together. The value of this entire company with leverage is the value of the company without leverage plus the value of the tax shields. So we get 472.22 plus 429 gives us 476.51. And we're done. That's all we have to do. We value the project with APV. Okay. Let's consider now WACC. Let's try to do the same firm, same very simple firm with the WACC. We know that the step for a WACC problem is to just discount the free cash flows by the WACC. And we already know the free cash flows. So the entire difficulty is going to be calculating the WACC at each moment. To help us think about this, I'm going to add an extra row here to this table for our discount rates. So let's think about RE, for example. What is the discount rate on our equity? If we have no debt, the discount rate on the equity should be the discount rate on the assets. So what happens at time one? At time one, we pay off all of our debt. Right? Our debt level goes to 0. So we have no debt here. That means that the discount rate on the equity should be RU, which is given as 20%. That means that our WACC is going to be 20%, right? If you're 100% equity and your equity is 20%, then that's going to be your WACC. So let's add on an extra row for that. So for this cash flow at time 2, because we don't have any more debt after time 1, that's going to be pretty easy to discount. We can discount that at 20% to bring that $20, to bring that $200 back to time 1. The trick, however, is to figure out the discount rate on the equity at time 0. It's going to be something different because we do have debt at time 0, so we need to work through that to get RE. Okay. While we're here, we may as well figure out how much debt we do have at time 0. We know we have some debt. We haven't valued it yet. So let's let's just do that. We didn't need this for APV, but we will need this for the WACC, obviously. This problem, it says that we're going to pay the debt off at the end of 1 year. The face value is $300 and the interest payment is $15. So we're going to have a $315 payment in 1 year. And we're given a cost of debt of 5%. That means that the value today of the debt is $300. In a year, we pay the bank the $300 plus interest, and then the debt level goes to 0. But today it's $300. I'll write a little subscript here for 0. That's times 0, the debt's $300. Obviously, at time 1, we pay it off, so it goes to 0. Likewise, we'll need to figure out how much equity we have at time 0. If we want to compute the WACC, we need these ratios of debt over value, equity over value. So if the total company was worth $476 and the debt is worth $300, then the equity must be worth the difference. It's going to be worth that $176.51. Okay. So you see where we're going. We're trying to figure out the pieces for the WACC. It's a bit of a mess. You should understand how to do this problem with APV because it's easy. Don't worry if you can't do it for the WACC, but I want to at least talk through it so you can see what we need to get in order for the WACC to work. We need to get the level of debt. We need to get the equity. We're going to need that stuff to figure out the discount rate on the equity. I'll add an extra row up here just to summarize what's going on with the equity. We just figured out that the equity must be worth $176 today. And then what's the equity going to be worth at time 1? Well, the only cash flow we have after time 1 is this $200 payment. And we don't have any debt, so we know that the discount rate at that point is 20%. So how much is the equity worth? It's going to be the cash flow that you get at time 2 discounted by the RU one time. That works out to be 166. And then at time 2, obviously, everything's gone. No more future cash flow, so the equity is 0. All right, so we have what's going on with debt. We have what's going on with equity over time. We still need to figure out what's going on with the discount rate on the equity. Okay. If we can get that, then we can get the WACC at time 0. Here's our very general relevering equation. We need to use this to figure out what the discount rate on the equity is going to be at time 1, or at time 0, excuse me. We know what it's going to be at time 1. It's going to be 20% because we have no more debt. But at time 0, it's going to be a little bit more difficult. We know RU is 20. We know that at time 0, the debt is worth 300 and the equity is worth 176. So we're going to plug that into the relevering equation. We know the cost of debt is 5, plug that in. What about the value of the tax shields? So it's weird that we have to know this to compute the WACC. That's just how the algebra works. We need to use that in order to relever. Fortunately, we already solved it in APV. We know that the value of the tax shields is 429, so that's going to show up in our relevering equation. Equity is 176. And then the discount rate on the tax shields, we already talked through this. It's going to be the discount rate on the debt, which was 5%. Sorry, I have a typo here. This is RU minus RITS. So the discount rate on the assets is 20. Discount rate on the tax shield is 5. So this is our relevering equation where we put in all the variables that we have. That allows us to calculate the discount rate on the equity at time 0. Work through that to get about 45%. So I'm going to put that in our table. We have 45% discount rates on our equity at time 0. Now we're finally able to calculate the WACC for this company. Since we have the discount rate on the equity, it changes, but we can calculate the WACC at time 0. It's going to be debt over value, RD, times 1 minus T, plus equity over value times RE. So at time 0, what's the debt worth? It's 300. The total value is the 476. So we have 300 divided by 476. The cost of debt is 5. And the tax rate is 30. Equity is 176 out of the 476. And the discount rate on the equity is this 45.13. That's going to give us a WACC of 18.92%. At time 0. And obviously once we pay off the debt, our tax shields go away, so that the discount rate goes up to 20% because we're not getting tax shields anymore. Okay, so you see that this is a bit of a work now. Not only did we need to know the free cash flows, but we had to figure out the discount rate on the equity. That gives us the WACC. The last thing we need to do is discount these free cash flows by the WACC. So I'm going to create a little bit of space here. The value of the whole company, then, the value of the levered project, is going to be the $400 that we get at time 1. We have to discount that by the WACC today, right? We have to bring this $400 back to time 0. That means we have to use today's WACC of 18.92% to discount that. Where things get a little bit more weird even is that second $200 payment. Notice that the firm discount rate changes from time 1 to time 2. So that means we're going to need 2 different discount rates. We're going to need to do something like this. You can think all the way back to the very beginning of class where we talked about what happens if you have a CD, or you could put your money in a CD and earn a little bit higher return over a longer horizon, or you could put your money in a checking account and earn a lower return for a shorter horizon. So you've got these different discount rates based on the horizon. That's similar to what's going on here. We've got one discount rate to move from time 0 to time 1. And then we have a separate discount rate to move from time 1 to time 2. So the total value of the company is going to be that $400 brought to time 0 at 18.92%. And then the $200 we got to bring that to time 1 at 20%. And then we got to bring it from time 1 to time 0 at the 18.92%. So you put all this into your calculator and you'll get the same answer. You'll get what we had with the WACC of 476.51. You can check it just to see. It looks very different, obviously, than what we did with APV. It was a lot more work, but you'll get the same answer. Okay. Finally, let's do it with the flow to equity method. Okay, so let's add some rows here for the free cash flow to equity. We're going to have a very similar issue with the WACC in that our discount rate on our equity changes. We're going to have a different discount rate to bring stuff from time 1 to time 0 than from time 2 to time 1, just like we had here. So that's still going to show up. We need to calculate this free cash flow to equity, though, first, and then we can discount those by RE. At time 1, we know the free cash flow is going to be 400. We know that we're going to pay $15 in interest. And what happens at time 1? We also pay back the debt. So our net debt issuance is going to be minus 300. Okay, just working through this equation, we know the free cash flow of 400, the interest of 15, the debt changed. It used to be 300, then it goes to 0. That means that we paid off our debt. Our debt went down by 300. That's going to give us a free cash flow for equity at time 1 equal to $89.50. And then at time 2, well, now things get easier because we don't have any debt. So we don't have any interest payments. We don't have any net debt issuance at time 2. So all we have is the free cash flow of 200. We got the free cash flows to equity. We got the discount rate on the equity. We just got to bring these cash flows to time 0 to get the total value of the project. We're going to have this weird thing again where we've got 2 discount rates for the equity. We need one to bring it back from time 2 to time 1. And then we need a separate one to bring it from time 1 to time 0. So we got $89.50 at time 1. We know that we have to bring that back at 45%. Then we have 200 at time 2. We have to bring that back at 20% to bring it to time 1, and then discount it at 45% to bring it to time 0. And if you work through that, you'll get the value of the equity of 176.51. So then the total value of the company is going to be the value of the debt plus the equity. The value of the levered company is going to be debt plus equity, which is the 300 plus 176.51. So we're at the 476.51 that we got before. So you see, if the discount rates are changing, WACC and the float equity are going to be a mess because you're going to have these different discount rates all the time. APV we were able to do without really thinking too much. We had the free cash flows, the discount rate on the assets. We had to calculate this tax yield, add up both present values, and we're done. Okay, so for a problem like this, you should know how to value it with APV. You should have a general idea that the WACC and the float equity are going to be difficult because the discount rates are going to be changing. But don't worry about doing a problem like this. I'm not gonna put this kind of ugly thing on the exam. This is all worked out in the slides here. So to conclude this lecture, when do we want to use each method? Well, if the assumptions of WACC hold, then WACC is great, right? If you have a constant debt to equity ratio, your debt to value ratio stays the same, then you want to use the WACC. We know that underneath the hood, the capital structure has to be changing with the project. If it's a good project, then you have to take on more debt to finance it. So that's all kind of going on implicitly. But to value the project itself, you don't have to worry about that. So you just kind of know what's happening, but you don't have to track it. With APV and flow to equity, you do have to know exactly at each point how much debt you have, how much interest you're going to be paying to go through those steps. So if your capital structure is changing, then APV is going to be the simplest, right? If your debt to equity ratio is going to change and you know what your debt's going to be, APV is going to be reasonably straightforward, but WACC and flow to equity are going to require a lot of relevering, and that's going to be difficult. And finally, flow to equity is good if you don't need to draw a line between free cash flows and cash flows from financing. For a financial institution, you don't know where the operations and the financing kind of mix. Where's the line between the operations of the bank and the financing of the bank? They're the same thing. So you can't draw that line with free cash flows. With flow to equity, you can just focus on the equity holders. Just focus on the total effect going to equity holders, and you can get the same numbers. You can get the same valuation without being worried about separating the financing from the operations.